Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Okay, welcome everyone. This is our weekly research meeting, and we've got a new format using Riverside that will hopefully be able to present better to you and look more like a proper podcast. So Joe, unfortunately Joe's camera is not working today, but will be next time. But Joe, take it away.
Okay, great. Thanks very much, David. Good morning. Just getting some year-end numbers for some of the LPs that flow into the master trust that anchors our alternative asset operations here at the firm. So we'll talk about kind of a quick summary of real estate. And I do have one table that points to, some of the reasons why the numbers were where they were at. And then we'll do charts of the week. Every week we point out that we're not providing investment advice at this particular research meeting, and that continues into this week, so please be advised. Okay, so just sort of from a broader high-level overview, our alternative asset program is the master trust up top. It's got 3 LPs in the middle, and the LPs go out into the alt space and source great deals for our unit holders down at the bottom. Today we're going to talk about the 360-degree fund. It is our main private and commercial real estate vehicle. Looks like we had a pretty good year, coming in at 17%. Very importantly, this fund reports in USD. So if you maybe kind of reduce that number by 3 to 4%, I don't know exactly what CAD USD did last year, but I feel it was around 3 or 4%. You're still looking at a rate of return, definitely in the high 12s and 13s, which is very good for 2 reasons. First, in the case of a lot of the more mature vintage LPs and deals, we do begin to model carry and those sorts of things. So it's a very clean number, but also the fact that in other areas of commercial real estate, you certainly didn't see, numbers like this. And we're not doing a victory lap or anything like that. Our work continues and will continue for many, many years. But when I looked at the fund sort of at a more microscopic level, I saw a lot of stuff like this. So this is an example of one of our sponsors in the real estate space, Ventura Realty. They happen to be a very, very good one. And some of the property names are described there. But the main sort of thing to draw your attention to is that column that says the percentage increase of the December 25 NAV over the original equity that we've paid. And so this is just like sort of a NAV spreadsheet model that I have. And this is just, more evidence, and we've been talking about this now for coming up on 9 years, that with residential real estate in some of these U.S. Markets, it continues to be not only a relatively good investment opportunity for people to have, but also one that spits out a lot of cash. So there is that cumulative distribution column on the right-hand side. And so you could see that on a quarterly basis, we are getting paid by a lot of these 200, 300, and 400 unit Class A garden-style multi-res deals. They really don't skip too many beats. I mean, there is some performance slippage on some of the vintages that are in that 2022 range, but you could see with some of the first couple of deals, they are way up, and they have returned a lot of money to investors. And this same story actually is very, very close to our work in land banking. And so, I've said probably half a dozen times, our approach to land banking has, quote, made a quantum leap from the early days. And we are now kind of more heavily involved with a group in Texas that is doing some very, very interesting things. And so I think, in the real estate fund, number one, we just managed to avoid a lot of the more gnarly asset classes within the space that really were having problems. And I think that's just a function of us, frankly, being a bunch of scared Canadians. But also just really focusing on the models and the stress testing and the underwriting assumptions that are baked into these pitch decks that all of us get on a weekly. And the glossies and the projections of fancy looking buildings are great. They're entertaining and kind of fun to look at. But you really got to dive into those models and assumptions, and also really have a good idea of who you're doing business with. We really tend to avoid giving money to groups that just for the first time ever, are thinking they're getting into the commercial real estate business. And I should have updates on the other LPs actually later today, I hope. And so at the next research meeting, I'll report on the overall performance of the alternative asset trust in general. And I do think we should be able to crack into the eights there. So time will tell. Okay, charts of the week. The really interesting thing here is that second bullet point. So the Bank of America Global Fund Manager Survey, and I really want people to sort of think about this. There's a lot of technical, obviously, slides that Andrew talked about in his weekly update, as he usually does. But late last night, one of our partners in South Florida, Daisy, sent around a research report from her firm's chief, economist type of fellow by the name of Dr. Ronald Lagnato, who's the chief economist at Universal Investments. And it's very, that was actually by Mark Spitznagel, not Ronald, sorry, different. So Mark is one of the co-founders of Universa. And his piece really spoke to the increasing importance of risk mitigation. And if you read through it, it seems to kind of be originating from, the U.S. fiscal situation, in particular, things like, the movements in treasury yields and that sort of thing. And so it's very interesting that this Bank of America Global Fund Manager Survey actually shows that portfolio managers kind of around the world, on average, are actually short risk mitigation and protection strategies in their funds. So they're really confident, and these are not dumb retail investors. They're people just like us who kind of presume that the stock market is going to go up forever. And it's really interesting because not only did we just have a dip right over here, and then another one over here, and then another one over here, but also because of the fact that Andrew points out the last time this Global Fund Manager Survey kind of pitched way down into the kind of complacency end of the spectrum, we had quite the sell-off. And, I chuckle because, once again, the way you make money in this business is not by, reaching for the stars. It's really by cutting your losses and having good risk mitigation. And I just talked about that in the real estate fund. And it works. And, I do not come from a commercial real estate background. I have a science degree, and that's basically it. And we were able to get our investors very good rates of return in real estate by not taking a ton of risk. So here you can see some of the important points that Andrew talks about. I'll kind of breeze through this just because we are a little bit, pressed for time. The main thing that sort of concerns him is this breakdown through that upward trending lower dotted black line. If that gets worse or continues, his concern about the stock market having made a peak will increase. To Andrew's credit, he's not sort of a blind technical analyst who just looks at one chart and then formulates his whole trading strategy from there. The other thing he talks about is, again, being vigilant. And so here you can see sort of a comparison between both the S&P 500, but also the QQQs, and really talking about those November lows. The other thing he talked about in his report was the similarities between past years and what's shaping out to be 2026. And so, just as a reminder, shortly after Valentine's Day last year, the S&P 500 started rolling over, and it was still yet a couple of weeks away before Trump began his formal tariff and trade war, right? So the market was already not feeling great about itself and starting to roll over. Andrew thinks that may happen now, but he qualifies that with other indicators. Excuse me, that's a silver chart. Let me just back up to this because I want to finish this point. He qualifies or sort of balances out that bearish case with saying, well, but the overall market is stronger due to more broad based participation on the part of other areas of the marketplace. And so that is a positive. We did not have as much broad-based market participation last year. And remember, as we kind of clicked into 26, you came out of a period where US equities really led the way, and now you're kind of seeing other markets maybe take the lead. So who knows how that transpires? But certainly you're getting an indication that for the S&P 500, he's just sort of bracing himself. I think that's the best way to describe it. It's like a boxer knowing you're going to get hit and you can't do anything about it. So you just kind of take a deep breath and brace yourself. Okay, so let's talk about silver. This is a really interesting chart for a number of reasons. First, this is a 45-year wide teacup pattern. So it's a big, wide window look at silver. And secondly, the sort of spike up in silver is very, very interesting on its own for two reasons. First, even though it looks like silver really spiked up and went parabolic, that upper dotted black line is the minimum price projection associated with a 45-year wide teacup. Secondly, the movement in silver pretty much went straight up to almost $100 without taking any sort of break. And so we saw this with gold. Obviously, we're gold investors, and we talk a lot about gold with our folks. So he is very positive on silver, and again, it's certainly taking its cues, I guess, from gold. But there is a silver shortage fundamentally. And just sort of as a brief reminder, one of the biggest and by far richest silver mines in the entire world, in the whole world, is just north of a lot of us in a town called Cobalt, Ontario, which is named after cobalt, obviously the metal from the periodic table, but just east of Cobalt, along Highway 518 as you approach the Quebec border, is by far one of the richest silver mines that's anyone's ever found ever. So very interesting developments there. In fact, some folklore from that mine is that just the scrap tailings, just the junk silver that they literally have laying in tailing pools is enough. And this apparently happened. Someone poured a 5,000 ounce bar of pure silver up there just from sort of the stuff laying around. 5,000 ounces at $100 an ounce. So that's a $500,000 bar of silver from scrap. Okay, so nat gas, we'll just shift into this. So he really called natural gas to a T here. But it looks like the markets were closed when he attempted to buy this nat gas ETF, UNG, and so I'd love some more thoughts on nat gas. I was just speaking with somebody about Enbridge versus Pado, and I don't really follow the stocks much, but interesting. So let's kind of dive into the main thing here, right? Spitznagel versus this Bank of America Global Fund Manager Survey. So again, Mark Spitznagel right? A hedge fund manager with like 20 gazillion dollars under his keyboard is actually warning people, just like the people that responded to this very survey, that risk mitigation is becoming increasingly important. Yet you've got portfolio managers, kind of, I guess, around the world, or whoever participated in this survey, saying, thanks, we're good. We feel we can, weather the storm. And I don't know how old the average portfolio manager is that responded to this survey, but if they're under 40, maybe they just weren't really in a position of kind of managing serious money the last time something really bad happened. So it could be that. I'm not sure. And then just sort of finishing off, got a slide here on Bitcoin. I think, quite frankly, Sean, you're probably better equipped to talk about that. And then this is just a carryover slide from last week. So just to summarize, I think this is sort of I don't like the term canary in a coal mine, but that's that there. So I'll stop sharing and pass it back. Thank you.
Thanks, Joe. Ken, you ready there?
Yeah, I'm just sharing one of my screens, see if that works. That works? Yeah. Can you guys see that?
Yeah, go for
Cool.
it.
Okay, so just a quick disclaimer for Canadian investors, and then U.S. investors a little different. Be pretty quick here. S&P 500, 3-box reversal over the week. Obviously some Trump and Greenland risk that kind of got eliminated yesterday at his speech. So we saw a nice little bounce back. Strong earnings so far. Most companies really start reporting next week, with Microsoft, Tesla, Meta, etc. But some weaker forecasts. Netflix had some weaker forecasts this week, which dragged their stock. So we'll have to see if that continues, or it was just a one-off just because of Netflix's pending transaction with Warner Brothers. Two strong support lines here. Broke 6 months of positive momentum, so the technical is really breaking down here. Overbought, oversold 12.5%. That's the lowest since November. It was actually oversold on Tuesday when I looked, for the first time in 8 weeks. And then valuations obviously remain elevated despite a bit of a tech drag to start the year, we'll call it. NASDAQ 100, 4-box slide, similar move. 1 box from support. There is a strong support zone here, but there's also some really strong resistance you can see in these two blue lines. It's basically been trading at this 12-box range since the middle of September. Like I said, tech's lagged in 26. Earnings, I talked about Netflix, weaker guidance on margins, and they're also pausing share buybacks to finance their purchase of Warner Brothers, if that is obviously passed. They also changed the deal to all cash to reportedly speed up the process of a shareholder vote. Overbought, oversold 2%. That's the lowest in 3 weeks, and only the third time it's been oversold since the week of last May 5th. So a big change there. Flipping here to the Dow, flat week over week, 4 column changes. I forgot to replace this photo. That's my bad. But it did create a new sell signal on Tuesday. It also created some strong resistance by reversing a few times over the last week, but it also has created some short-term support. The defensive rotation in our mind continues. The defensive components of the Dow versus the growth really kind of spreading out, and you're seeing really the defensive companies within the Dow 30. If you look at a visual chart of all the performance of the Dow components, really seeing a spread between growth and defensive. The strongest outlook on a technical basis for a U.S. index is the Dow here. Overbought, oversold 37% almost. It decreased week over week, but remains elevated relative to the U.S. growth indices. remains positive on a monthly basis in terms of momentum, and then the trailing 12-month PE still a little cheaper than where it was sitting 1 year ago. And then up to Canada, no box change week over week. Commodity strength continues this week. We think there's like I said, a continued flock to stability, defensive, and stores of value like gold, silver, and even platinum. Um, Target is only one box above where it sits right now. PE ratio obviously depressed relative to U.S. indices, so a little more upside there. But really, the technicals look the strongest. Overbought, oversold 61%, and that's the lowest in 4 weeks. But the demand that we've seen remains robust for Canadian equities. It's been above 45% 8 weeks in a row, and now overbought, oversold is obviously a supply and demand technical data point. The higher that data point is, obviously, the more overbought a stock is, the lower, the more oversold it is. And when it's below zero, it's oversold. Looking here at some technical indicators, obviously just the VIX. We had a couple changes this week. New buy signal, 4 straight, spike in volatility over the week. And it broke to a positive trend like we've been forecasting. You can see it jumped above this line, which is the positive trend line. We think this elevated move and these higher lows that we've made since basically the end of last year will continue, just from a technical standpoint. Bullish percentage charts, these two charts have up in recent weeks, but a little slower moving with the way markets have behaved recently. And then, like I said, the Dow continues to be the strongest U.S. indice in our eyes, moving up 6%. So now 82% of the Dow components trading in a positive trend. So quite the spread there relative to the NASDAQ. And then looking here up north, both of these two charts have moved up once again this week, really painting the strong picture for Canadian equities right now on a technical basis, but also, like I said earlier, a fundamental basis. Looking here, this is the asset class rankings. Not a whole lot of changes. Just a couple flips of buy signals here down at fixed income, and then within the size and style. But the biggest change, tech, lost another 8 buy signals week over week, and it's lost 22 over the last 8 weeks. Dating back further, it's lost around 50. So the tech slide real continuing, and we think that the acceleration there could continue. I mean, you even had the Citadel founder, Ken Griffin, saying this week in a speech that we're basically over monetizing what AI applications and the revenue generation of these companies to justify data center spend. So we'll have to see if that obviously thesis comes true. Just looking here, this is the energy ETF XLE. It's at multi-year highs despite oil trading in the 60s. Obviously, oil moved all the way down to the low to mid 50s, but really bounced back up to about $61 recently. But this energy ETF, we're seeing a rotation more into obviously commodities, inflation protected assets. A lot of these energy producers trading at really attractive multiples, and the risk reward right now, especially with all the geopolitical tensions and even with what happened a couple weeks ago in Venezuela, really attractive. Now this is crude. Not saying the technical chart looks great, but it's been overbought the last 3 weeks after immense selling pressure basically since the middle of the year, and potentially have found the bottom here. If you go dating back multiple years other than COVID, this is kind of over the last few years the last line of support that we got to in the mid to low 50s. And I would assume we would get a lot less supply online if the price of oil continued to drop, unless it was just some quick flash crash that we saw. Looking here, this is U.S. core equity ranking based on a percentile basis. So it's basically where the U.S. equity trade is ranked on the Dorsey Wright platform. You can see here, obviously, this is the number of consecutive days it's traded above 90%. And when it obviously ends that streak, which it ended that streak on um, January 15th, which was obviously last week. But you can see historically when that happens, the only negative return forward looking for the S&P 500 is 2 weeks. Historically, you've had some really strong returns. On the yearly basis, we had negative returns in 22 and 2015, but just this chart really reflects the historic run. Obviously, U.S. equity funds have been on, and this chart kind of talks about the same thing. U.S. exceptionalism. Foreign investors now hold about 21 trillion in U.S. stock. That's a record, obviously. It's about 32.4% of all foreign held U.S. financial assets. And now this percentage, obviously, you can see eclipsed the previous high in 1968 of 31.4%. So even obviously foreigners continuing to pile in despite some record high valuations. And obviously you can't really buy U.S. tech in other countries. Looking here, this is the value versus growth versus defensive that I wanted to kind of talk about. It's not a perfect chart to describe what I was saying in terms of defensive, but you can see recently we got this flip over on this relative strength chart. When it's moving lower, value outperforms. When it's moving up and creating these green, growth is outperforming, and we got this reversal over the last few weeks, something that we're watching really closely. And then a couple more slides here. This is just another chart from same survey Joe talked about, Bank of America's Global Fund Manager Survey. Just talking about cash allocation. It dropped to a further record low in their most recent fund manager survey to 3.2%. That's the lowest level in the survey's history. So we had this mass amount of cash on the sidelines just a couple of years ago, and now it seems it's mostly been allocated, and you're really getting the blow off top of this market and a bit of FOMO and probably some managers closet indexing just because they've underperformed the general markets over the past few years, and they can't justify to their investors why they don't own the likes of Nvidia and the Mag 7. Looking here, a little bit different, obviously, than cash allocation. Something that we like is a better store of value, gold. The tailwinds continue. Retail, central banks, and institutions are continuing to flock towards it, seeking safety and the other benefits that gold provides. You can see this is China's holdings of gold and U.S. treasuries, gold reserves at record levels. They really piled in over the last few years, while their U.S. Treasury holdings are now at 18-year lows, and they're continuing to accelerate their sales of U.S. Treasury. Looking here, this is copper. Obviously, we've talked about a lot of commodities, but copper, you can see here on the left side, this is the copper ore grades that are being mined globally, and you can see the grades obviously deteriorating. That's no surprise to anyone on this call. That leads obviously to higher costs, supply constraints, and more complex projects. At the same time, copper demand is obviously roaring. We all know that. There's more applications than ever for copper, but discoveries have over a decade on decade, have declined by over 90% over the last few decades. When you compare it to the late 80s to early 90s to the last 10 years, copper discoveries have collapsed by 90%. So perhaps some massive opportunity sets there for investors with little exposure to industrial metals. And then, like I said, a lot of commodities on the call today. This is just the ETF's market share of commodity ETFs versus all ETFs. Commodity ETFs still really make up relatively low allocation in terms of total ETF assets, which is a reflection, I think, of investors' assets and their portfolios exposure to commodities back in 2011, 2012. That number was above 10% for a couple of years. Today, that's collapsed. It's moved up recently, but still sitting at around 3%. And I think the potential that increases over time is high. And then finally, just a quick chart on Brazilian stocks from this is Bloomberg and Tavi Costa, who works at Azuria Capital. Just Brazilian stocks over the long term, over the last 20 years, really breaking out of this long-term technical candle chart. These are monthly candles. Obviously, Brazilian stocks, really attractive multiples. It's a commodity-heavy economy. If you really believe we're in a commodity super cycle, investing in a lot of these emerging markets, especially a resource-rich one like Brazil, really could lead to outsized returns. We only own some exposure to Brazilian stocks through our emerging markets exposure, but continue to look at a lot of these ETFs of countries, in particular in that region. And I think I'll pass it over to Dave.
Great. Thanks, Ken.
Good morning, everyone, and welcome to this morning's brief update from January the 22nd, 2026. My name is David here at NASDAQ, Dorsey Ray. Yesterday's action positive for most indices we follow on the video here. So the Russell 2000, S&P equal weight lead the way to the upside. RUT up right at 2%. Even saw a rebound out of international equities, EM leading developed markets, EFA there, but both up over 1%. Crude just up a few 40 basis points, while we saw gold up about 1.5% there. Notable chart action from U.S. equity indexes came from the Dow as well as Russell 2000. We saw the Dow reverse back into X's there at 49,200, still technically maintaining the sell signal. From here, move above 49,800 would be a new all-time high, but also be a return to a buy signal. We saw that chart action still support there at 48,000. As for the Russell 2000, moving above 2,700 there, marking a new all-time high on its chart and continuing its upward column of X's there. Ultimately, unlike many indexes, didn't reverse down the nose here recently, so continuing to move into overbought territory there as well, just worth bearing in mind. As far as indicator action goes, we did see some 10-week action as we saw some reverse back into X's there where the NDW 40 or industry groups here. This is the distribution curves of those 10 weeks there. Still see a slight skew to the right here, if you will, with an elevated average rating right around that 60% mark. So roughly suggesting 6 out of every 10 stocks on average within the sector maintain above their 50-day moving average. Those highlighted in red are recent reversals following yesterday's action. In the case of being capital letters, the reversals back into X's, lowercase, meaning they're in a column of O's at the moment. And then when we take a look at those bullish percents, measuring the percentage of stocks maintaining point and figure buy signals right now, did see some action there as well. A couple of reversals down for protection and safety as well as computers, but still see somewhat of a normal distribution here with an average reading right around that 50% mark. We did highlight that in Tuesday's pulse as part of its current look and sort of its inflection point that it currently sits at in terms of that average reading. Moving on to individual stock action, Alibaba among the big notable movers this morning as they announced plans to IPO their chip making unit, their internal chip making unit. Last week's action saw it move back into a positive trend, improving it to a 3 for 5. Yesterday's action led to a reversal there up at 168. Currently pre-market trading at about 175, so showing the potential of giving a second buy signal there, possibly moving to its highest level since October of last year. Note that rally high there at 182, as well as the stock's all-time high, or pardon me, that 2025 high there at 192, all-time high sitting back in 2020. Pardon me for that slip up there, but still seeing quite a bit of improvement, at least in the very near term, out of BAPA, continuing to see some intraday action as well. Moving on to earnings upcoming, among those reporting, Capital One Financial, COOF, did see a reversal in sort of downward action to begin the month, but still technically maintaining a buy signal. Currently holding support there at 228. Could look at 200 as an additional level of support, while the bullish support line sits there at 190. From here, reversal into X's comes with a move above 240, while the second buy signal would come with a move above 244. And then moving on to additional names that we're seeing reporting today as well. Freeport McMoran FCX, a 3 for 5er, has seen pretty notable improvement in the back half of 2025, beginning here in 2026, getting a little extended as it sits in overbought territory there above the top of the 10-week trading band. Possible reversal down if it moves below 59. We currently have support there around the mid 50s, marking at 54 as well. So that's what we can keep an eye out for. And then from there can look for prior resistance around that $49 level as potential level of support. Also for FCX. GE Aerospace, another one reporting as well. GE has maintained a buy signal since December, seen some consolidation like some other stocks, currently holding support there at 312, additional support at 292 along with 280. Reversal back into X's comes with move above 324, second buy signal if it moves above 332. After the bell, we see Intel, INTC being among those names reporting as well. 5 for 5ers giving consecutive buy signals since December, currently sitting in overbought territory at its highest chart or price level we've seen since early 2022. So worth bearing in mind there. A little bit of resistance that we're coming up to here in the mid 50s that we'll keep an eye on. Moved into overbought territory with yesterday's action, but monitor support there at 47 and actually improved to a 5 for 5er with yesterday's action, reversing up into its pure RS chart. But again, support there at 47, prior resistance at 44, around that mid 40s could be another additional level of support, but also see support there at 41 and 39 for the stock. Move above resistance there in the mid 50s would be pretty notable as far as potential additional upside action for the stock. Just to show the list of additional names we see reporting today, capping off here at Procter & Gamble, also see Northern Trust, McCormick, Intuit Surgical, along with CSX, and even Abbott Laboratories among those reporting today as well. But as always, if you have any questions about a particular
So this is a bi-weekly report we get from Glenn Orkey. I'm going to hide this thing. We should all remember to hide this because it's obnoxious on the bottom. They are our value manager out of Australia and New Zealand. They do this bi-weekly report that I'll go through briefly here in place of Michael Coolbaugh this week. And I think they're quite brilliant. They asked their thousands of followers to send pictures of sunsets. So I think that's always a clever way of doing it. We do it with lighthouses, which is starting to catch on. So these are the subjects that I'm going to just jump through really quickly today. They comment on U.S. shale, changes going on in Venezuela 5 years from now. This one just came in, by the way, so I'm just going to highlight. I haven't read the context yet. Argentina tax system. There's a tsunami coming. I don't know what that means. Private equity in Argentina. Happy New Year between Europe and China. I've looked at that. Trends in motion, worth watching. Pressure in the Permian. That's also related to the U.S. shale again. And New Year's resolutions and predictions. And PSYOP spotting tools. And then they cover 4 or 5 names at the end, which I won't do today. Try to keep this high level. So you can see the Permian, can't pronounce it myself, has come off tremendously when the U.S. administration claims that they're energy self-sufficient. This chart makes me question that and why they might have had no choice to walk into Venezuela and also to tie up Iran and China by that move. They like their cartoons as well. So there's going to be a ton of supply, they think, coming from Venezuela to keep prices down. Sean, they do some nice cartoons as well here. I really thought this one was interesting. How would you like things wrapped? And control of the internet speech is really becoming a hot topic in countries, with the UK being the leader in that and Canada following on its heels. So everything we say is going to have to be filtered and muted and talking in some kind of a new speak that only intelligent people can understand. Number of operating rings in the per million off tremendously as of February of last year, 270 down to 220, so 50 off. Another interesting caption here. So yeah, stable coins are really going to be acceptable. Hard to say the average person will really fall for that unless they're forced to. And then they go into Venezuela 5 years from now. I have not read that, so I'll take a look later. Goldman clients, not Goldman Sachs itself, but the Goldman clients, according to this survey, are extremely bearish, the most in 10 years. And groups like that tend to be wrong at turning points. And so this is why we're taking a closer and closer look at it. And even the S&P 500 has got percent premium to 10-year average price earnings valuations, just off the chart for energy and real estate. Yeah, and this is a very long-term chart going back to 1990. You can see oil and gas equipment and services peaked out in around the 07 era for the credit crisis, and have been flatlining for the last 4 years or so, 5 years or 6 years, I guess it would be. And Argentina tax system overhauling. What's this about a tsunami? Yeah. Oh, it's basically their country risk. And while we're getting this through our emerging markets exposure, we might want to even take a closer look directly investing in the country. Some private equity opportunities. Now they show some New Year's celebrations. That's what happened in France, where supposedly over 1,100 cars were burnt on New Year's Eve. And lots of videos here that I'm not going to play, but migrants in Birmingham, and more mass migration going on in parts of Europe. Where exactly that would be? That would be in Brussels, Belgium, and some more challenges going on in Lisbon and Germany. So a lot of unrest, a lot of young people unhappy in Europe, people in general unhappy. And yeah, the world is changing here, but China, everything's rosy in China, of course. Not really allowed to protest there. This is an interesting chart that I had a quick look at. The UAE is attracting millionaires the most in the world due to their low taxes, residency programs, high-end lifestyle offerings. I know these two principals of Glenorchy have that as their secondary residence, as their escape hatch, with the U.S. following second. Is Canada even on there? I don't see it standing out. Maybe it's down at the bottom with mass exodus, which I wouldn't be too surprised about. No, I don't even see them on the list, so I'll have to take a closer look later. Finishing up here, because this does get on and on. This is an interesting image. So Shenzhen in 1980 versus 2021. And I assume that's the exact same landmass. Don't really see that mountain in the background, but I have to take their word for that. And then more on the Permian pressure there. And so this will be worth an extensive read. And Ken Reed and I, if we find any more things on it, we'll be bringing it up in the future. I like this New Year's prediction. Any believable prediction will be wrong. Any correct prediction will be unbelievable. I think that's a great quote. So as they've said in the past, expect the unexpected. PSYOP spotting tools. What are they doing here? This will probably need a better read in order to better understand it. Okay, that's it. I think someone was talking earlier about the recent spike in natural gas. Um, I'll send this around to all of us so we can have a look at how the nat gas trade has just exploded lately and see what's happening there. And moving along to how the various indices have been doing. And so the Nasdaq looks like it's suffering. France, Italy, so problems in Europe starting to appear. India, hopefully that's just a momentary setback from India because we do have a starting position there now. And yeah, so tremendous growth again in the venture exchange. So Paul Beatty, we'll hear from you later, and hopefully that continues to benefit you in 2026. Energy. So we've got crude oil, but look at this, 30% up in the weekly for nat gas. So we've got some exposure to that will help us. Gold and silver continue to roar ahead, with silver up 31% year to date. And that's 22 days into a year. So well over 1% a day. Incredible. I'll comment on the Canada US dollar and interest rates when I move over to point and figure. So Canada US dollars at 72 cents right now. Short term on point and figure measures down to 68, and long term measures down another 10 cents to 62. That could easily happen if this US dollar spot index starts moving up again, because it's had a downtrend for the last year. But according to point and figure, it claims to have bottomed out and will be heading up higher. That will put pressure on our Canadian US dollar. Crude up 6% year to date, this month, I should say. And yeah, but it still measures down. Whereas nat gas, it's had this tremendous month, up over 30%. And it looks like it could even double here, according to point and figure. So I think it's time to watch it settle down a bit and then add some positions there. And copper up, uranium big up, gold. The futures look to be flat, so they might be taking a breather here. Same thing as the spot price. The gold index bugs measure up a bit. Yeah, the entire space, precious metal space up. Now, silver, as I said last week, may look toppy here, even though it was up quite a bit in the last week. So we're up to $92, measures down to 79. So I know Fred Hickey took some silver exposure off. Now, he would have done that probably back in December, and he would have missed this 31% up. So I think we can be a little bit slow and take some more off here, because sooner or later this has to settle down. Yeah, that's it for that. Platinum looks like it's overdone here. And so Bitcoin still has this crazy $226,000 target. Whereas Ethereum's measures down, Solana way down, and the crypto space itself way down. Let me just finish off here with interest rates, and then I'll pass it on to you, Sean. So I don't think there's been a great change here. No, the short end is still at 3.5, measures down to 2 3/4, and the 5 and 10 year measure up. And the 30-year actually measures down. So yeah, it's the same as last week. We've got sort of a bell curve interest curve here. Okay, that's it for me. Yeah, take it away there, Sean.
Okay, so macro overview, got shellacked in the last week. That's pretty much due to crypto and the failure of the Clarity Act. Brian Armstrong, the CEO of Coinbase, has come out and said, well, we'd rather just there be no Clarity Act than a Clarity Act if this is what they're going to do. And when you dig into it, the banks like Bank of America are like, if you guys do this, we are going to have massive deposit flight out of our bank. into stablecoin based deposits where people will earn more interest because they have lower regulation and lower overhead, and you'll fuck the fractional banking system. And so they've watered it down, and it now I don't know where it ends up. I mean, this is like a pivotal moment, frankly, for the crypto industry. The only thing that is positive in the narrative is that Trump mentioned it in Davos and in his speech. And he seems to be like, okay, he solved Greenland. They're going to do Cuba next, but then they'll eventually figure out this Clarity Act, because God knows the Trumps will make a lot of money if it works. So big picture, the only thing that is breaking right now in the headwinds is the yen carry trade is further unwinding. Yields are going parabolic in Japan. But at the end of the day, the Japanese own most of the debt. And there's this crazy idea that at some point, the Japanese will cancel their debt once they get above, some people have said if they get somewhere between 90 and 95% of JGBs being held internally, they'll figure out how to cancel the debt. It'll decimate the yen, but it'll make them unbelievably competitive from an export basis and maybe kickstart the economy. So that'll be the greatest economic event of our lifetimes if that's what comes to pass. I'm seeing more concern over November midterm elections, and uncertainty is starting to creep in. On the plus side, I went to a great presentation on copper and the future of copper. I bought COPX and COPJ the other day. I'm pretty happy with that as a new position. Asset classes, gold is just kicking butt. Oil, it's just up on Iran. I think that'll go back to being a negative print soon enough. Economics, really not a lot of change, right? We're still, we've got a dovish Fed that's looking to do soft QE. We're looking at very slow changes in employment with this low hire, low fire kind of mantra. Inflation is above target, but guys that are following it kind of in real time expect the change in housing and owner's equivalent rent to bring it down. Growth actually ticked up even higher by Atlanta Fed, and I see this morning that the GDP print got revised up by 0.1%, like 4.4% with inflation at like 2.5, 3. I mean, this year could surprise us all to the upside. I'm just, trying to figure this all out. Recession watch, not now. Commodities, rising prices, as everyone has said. Housing, seems to be a big focus of Trump. And like he brought up this idea in the Davos speech of potentially giving homeowners the ability to declare depreciation on their real estate. That'll be amazing if that happens. That'll be a consumer catalyst for sure. Okay, the US dollar has just been in this sideways basing motion since May. I think, the trend is likely to be lower once we get Powell out, but we'll see. But it's been like kind of in this range of like, 95 to 105 for, it's where it's usually is over a very long period of time. That's where we're sitting, but I do think the risk is to the downside. Gold, nothing stops this train. It just keeps continuing. So I'm just going to leave it at that. Bullish market. I think M&A boom is coming. Talked to a friend of a friend who's high up in one of the big Canadian gold companies, and they just can't believe their situation right now. Like the cash is just pouring in. And so they're likely to start doing some consolidation. Silver, parabolic, and now you're getting people that rely on silver, like Elon Musk is complaining about the price of silver. Just remarkable strength, poor man's gold, very accessible. How much is true demand versus speculation? Doesn't matter, the price is going up, but parabolic moves don't stay parabolic. It's not going to grow to the moon. Copper, it seems to be the new theme in today's meeting. the demand from electrification is quite astounding. And Trump even touched on this in his Davos speech, where Mark Zuckerberg showed him, their next big power plant or their next big data center, which is going to be like bigger than Central Park. Amazon, a retailer and cloud company, just signed a multi-year agreement with Rio Tinto to buy copper, right? Like, this is how far deep into the supply chain these guys are going based on their ambitions in AI and data centers, right? They're, Google and Microsoft are activating nuclear power plants and doing very long-term nuclear power deals because they see a future where, data, memory, cloud computing is just going to be staggering. So to build all of that, you need copper. Oil, still in a bear market. Recent pop is due to Iran. It's just in a downtrend. And when I think about where we're going, 6 months plus, now that Canada said, okay, we're bringing in like whatever is 39,000 Chinese EVs. We're going to see them on the road. We're going to hear about the prices. We're going to hear about the quality. And then it's not going to be 390,000 or just a couple percent of Canadian car consumption on an annual basis. I'll bet we're up to 10%. We'll be bringing in 100,000 cars next year and maybe 200,000 the next year after that. You simply can't compete when, you can't have a $70,000 Tesla and then the Chinese equivalent being 35,000 when they actually have better battery technology. This is going to be a snowball that rolls downhill. If the new motors and the new battery technology that was announced at the Consumer Electronics Show for Donut Labs is actually real, it is going to challenge internal combustion engines across many traditional modes of transportation. Oil is never going to go away, but the marginal value of it will probably just stay down around here, and that's a disaster for Russia, Venezuela, Iran, and frankly even Alberta. Natural gas, again, these moves are unbelievable, but I'll tell you, there's a whole industry of guys that do incredibly sophisticated weather forecasting. There's this one guy named Ryan Hall. And that little new info is from him. Like, he predicted this cold snap hitting the US and being basically entrenched for a little while. And the guys that subscribe to his service and some of these other services, they got the call on this a couple of days ago, and they've just been making hay. And I think if you look at that downtrend in natural gas, there were a bunch of guys who were like probably shorting it. And then this is just a massive short cover on a really disruptive weather pattern in the US, which is here. They're expecting ice storms. You can see this is in Fahrenheit, but you can see where they have very below average temperatures down into like Nashville and Memphis, Raleigh, and they're expecting like this severe cold front from Canada just to wash through. And now they're expecting like massive ice storms, massive power outages, and massive even natural gas supply disruptions because of the ice storm. So I expect that it could frankly, like you said, Dave, it could double again here. But it will come off very hard when this weather system clears. Might be worth, like looking at some of these advanced forecasts for when that flips over. Anyway, so as you said on rates, really no change since the previous report. They're trying to jawbone rates lower. The Trump is like, I want house prices lower, but I don't want to hurt my base whose house prices are going to be lower. I don't know what they're thinking there, but we will see. Equities seems, S&P 500, there still seems to be resistance up around 7,000. Trump tacoed on Greenland. I mean, frankly, like I don't think Greenland was ever that big of a deal. Um, what they're going to do in Cuba will probably get a lot more attention. The fact that they're not talking about it tells you how active they are right now, frankly. Breadth is good in the market. We're seeing a rotation. Small caps are outperforming, which is great. I'm seeing some cracks in the AI names just because of like this transition from training based chip sales, which NVIDIA definitely led the world in, to inference based deals where NVIDIA is buying, was it Cerebras, and other guys are, no, they're buying Grok, and OpenAI is doing a deal with Cerebras. Those are like the chip systems that are used when you query the large language models, not the chip systems that are used to train. Google has arguably best in class with their TPUs. And again, I said I like in Google, and I still like it. The VIX term structure is normal. Earnings trend is still positive. The sentiment has backed off a little bit, but not really that much, right? We've slipped back to neutral from a bit of greed, but that's fine. The crypto market is slipped. It's back into this, bear market trend. It's got this fluctuation around 90,000. It's frankly a disaster, right? Like, I talked last week about guys saying like, is it even investable anymore? They don't want to be seen with it based on how volatile it's become. The use case for it is falling. And I think we could see it fall as low as $45,000. Here's a look at Bitcoin. Yeah, who needs Bitcoin? Is it investable? And I've halved the allocation that I would recommend for anybody. Like when I look at my heat map, which is a short to medium term indicator, we're seeing red creep from top down. Um, it's just not a good situation. And it's all based on the Clarity Act, but the banks are fighting this thing tooth and nail. And we are in the fourth year of the 4-year cycle, and that's just generally bearish period. Gilbert's slide that he brought up, I'm still expecting a bit of a rough patch for equities as uncertainty around the midterm elections ramps up. My favorite trade continues to be the US 2-year. I've got a large leverage position to it. Not working yet, but it is a hedge against calamity, unlike some of those other managers. Having been in Bitcoin, it's been pretty volatile. Cuba is next, right? Like they are, this is from the Wall Street Journal this morning. They're actively seeking regime change under the Monroe Doctrine or the Donroe document or mandate. So I do think we'll see that happen, and that's just going to embolden them to like take a tougher hand with Canada. Carney really pissed Trump off with his speech, apparently. So I'm going to expect Carney to get it in the gut pretty soon. And here's today's cartoon. Trump tacoed on Greenland, in my opinion. So anyway, there he is serving tacos to the Greenlanders. That's it for me.
Sean,
Yeah.
just on the consolidation comment for the golds, are you suggesting that groups like Agnico Eagle and Barrick are going to use all of that cash to start swallowing smaller junior companies?
Yep.
Okay,
Yeah,
and then on the taco thing, is that because they were thinking of flying Trump to Alaska and telling him that he was in Greenland and having some Greenland flags, put up into the ground and a ribbon cutting ceremony and saying, Mr. President, we got it?
Yeah. No, I mean, he wanted like complete sovereignty over the country, and it just didn't happen. And like he threatened trade tariffs, and then like those wily Europeans said like, look, we'll give you like basically sovereign bases, right? Because what this is about, they want to control the water. First and foremost, they want to control the water off of Greenland. and I don't know what it'll be, like 100 miles, 200 miles offshore of Greenland, will basically be considered, in a way, like the equivalent of U.S. waters. Whether long term that's due to maybe there's oil, or maybe they just want to make sure that if they're installing this golden dome, that Chinese and Russian surveillance ships can get within, I guess, what's considered radio frequency range of these areas. And Trump even alluded to what technology they have in the Davos speech, where he said, when we went in and they were firing ground to air missiles at our planes, they didn't work, right? They basically did like an EMP that basically disabled all of this Russian and potentially Chinese air defense system. And so nothing, like not one plane, not one bullet, frankly, even hit like a U.S. aircraft.
Right.
And so you have to maintain distance, though, from that. And if I think that's what all of that is about. Like, you're not going to be doing that much mining on Greenland anytime soon, that's for sure. But anyway, they basically got what they wanted. And then Trump basically said, okay, I don't need all of Greenland. I'll just take these bases and I won't impose the tariffs. So he goes to these extremes and then he walks it back, right? The market hasn't figured that out yet. He went to the extremes with the tariff tantrum, and then he walked it all back. And then we had this amazing rally. So that's why it's like Trump always chickens out.
Sean,
But he did kind of get what he wanted.
Sean, to get off Trump for a sec, you've heard this. One of the biggest advocates of Bitcoin changed his tune last week, and
Who's that?
I've forgotten his name. Is well documented. He suggested gold at 20% a bunch of years ago, and then he switched to Bitcoin as same kind of safety play, protect your wealth, blah blah blah. And he just switched back last week, saying there is a big risk, in his opinion, that within 2 years, quantum computing will be sophisticated enough to crack the Bitcoin code.
Yeah.
And
But if that happens, every credit card, every bank, every security code in the world is also broken, and Bitcoin will be the least of our friggin' problems.
no, that's not true. Bitcoin is too
Why is that not true?
because they're Bitcoin is based on a hypothesis that it's uncrackable, and so your bank account will still be your bank account as long as you've got a printed version of how much cash you had in it, right? Even if it gets stolen, you can go back and say, "This was my bank account, please."
Yeah,
Whereas,
I mean, up to 100 grand, but
no, just okay. Well, anyway, you could argue
Okay,
that the whole world's going to
like-
come to an end with a quantum computing. I'm not sure I'm there, but I can tell you this is a major problem for Bitcoin. Okay, so
Paul, I have studied this
Yeah.
for like
What's your
7
view?
years, and I can tell you it is not a problem. It is a headline risk, right? It's a headline risk, but Bitcoin has constantly evolved. Less than 5% of the original code base remains. It will adapt, right? Right now, SHA-256, the actual, cryptography is far better than anything that a quantum computer can solve. When it comes time, like right now, like the smartest guys in computer science that work on this project for free, which is like really quite unbelievable, they are ensuring that we will be crypto or quantum hardened over the next while. But yeah, I've talked to guys from the Perimeter Institute in Waterloo about this, that, and the other thing is like, if quantum is actually breaking financial encryption, we'll have a lot bigger problems than Bitcoin. And that, again, that's why Bitcoin shouldn't be more than 10% of anyone's portfolio and 5% most likely.
Okay, so I mean, you may be right. I don't know, but I can tell you that the stock market, the investors, are going to somehow put a weighting to the risk that it's crackable, right? And
Yeah,
so
I mean-
well, I'm just saying, I don't know what the percentage is. I'm just telling you, one big advocate switched last week, and every single crypto person I've spoken to says they can prevent quant computing from disrupting Bitcoin. Every single one. Nobody says it's not doable. In fact, they say it's quite simple. He's come out with the opinion that, in fact, that's not the case, that he's very worried about it. And so I don't know. I mean, and I'm not sure many people do know. But I just think you've got to take that realistic risk and put it into your pricing on all these cryptos. And I think it's going to be a major issue, not just for the next few weeks or months, whatever, but for the next few years. And so I think this is a lot of the reason that crypto is not as appealing right now, because people are assessing that risk. But that's just
right. I just think there's a lot of better plays than crypto right now, right? Until we get real US dollar debasement, the use case has gone down since the rise of stablecoins. Like, who needs to transfer stuff on a secure blockchain like Bitcoin when you can do it on a secure blockchain like Ethereum, right, on something that is pegged 1-to-1 with the US dollar?
right.
Right. Like, I'm seeing like the use case for Bitcoin is actually declining.
Yeah. Okay.
And that, like, that was my focus for, since 2017. And, I'm coming off it now. Like, I think there's better potential. Copper, AI, tech companies, the new peptide therapies that are coming out, the next generation of the CRISPR machine, the impact on human health, the new motor technology that's coming out for EVs. There's like, these companies are going to be, one of them was already snapped up in England, YASA, and they'll be coming out, I think, in BMW cars this year. And like, these motors weigh a fraction of what Tesla motors weigh. Like, and again, that leads into like the biggest trend in oil. Anyway, thank you.
Hey, Dave, can I just jump in for 2 seconds? Because I gotta call in 3 minutes for the client.
Sure. Chris Curry, please mute yourself. We can hear you breathing.
Guys, I just wanted to
getting ready to go.
Yeah.
I know, but just mute yourself while Paul goes.
Sorry to jump the line, but I just wanted you guys to know that I'm going to a conference the end of next week or whatever, the beginning of February, and guys have asked for our top picks, right? You know where we stand on this. We're convinced Canada's going to dramatically outperform again this year. It did it last year. It's going to do it again this year. You should have at least some interesting Canadian plays, because all sorts of stocks are going to go up quantumly as the Americans and the rest of the world sees the value. So I just wanted to highlight the three we're going to pick. We like them all. Our top gold pick, by the way, is still Aris. Aris Mining was our top pick the last 2 years. Last year, and again, it's this year. This company, Aris, has gone up 3.5-fold in the last 12 months. It's one of Frank Juster's companies. It's now a $3 billion company. We think it goes to $10 billion, and we believe that because the stupid stock, after all this run, is only trading at 3 times EBITDA. Okay, they have no debt whatsoever. So a growth company with in the gold space trading at 3 times EBITDA is just unbelievable. Juster, I was on the phone with him last week. He said, this is not a gold company anymore. This is a money printing machine. So anyway, Aris Mining, ARIS. Then this Nurse, I don't know if we've ever talked about this thing, but NURS. This is a hyper growth healthcare story. It's just amazing what these guys are doing. So they're the Uber for nurses, right? So if you want a nurse's skill set for a month or two or whatever, you need a nurse, you contact these guys, and they have thousands of nurses signed up for them. So it's just like renting an Uber. You rent a nurse for a while. They do that, but then they've got this other thing called which is online pharmaceutical business. And
what's the symbol for that
Nurse,
one, Paul?
NURS.
On what exchange?
I think that's on the venture, the Canadian exchange, right? The small cap, NURS. And we've met with the guys a couple of times now. We've got a big position. This is hypergrowth. Okay, they're online pharmacy business, so they're registered in every state in the U.S. And apparently, in the pharmacy world, that's a pain in the ass to do. Highly regulated, like our business, but they have to do it at the state level. So they're in all 50 states, and they have a platform. And people are flocking to that platform. Businesses are flocking to that platform to sell their goods on the platform, right? And so the company's gone from zero online business to we think they're going to do 100+ million in 26. So 100 million in revenue. The nurse business is another 30 million in revenue, so 130 million. The market cap of this thing is 200 million bucks, maybe 220. So we think this stock goes up quantumly this year. I mean, how many healthcare stocks do you know growing at 100%? That trade at less than 2 times revenue.
The symbol isn't coming up for me. Is it coming up for you, Dave?
Yeah, I got it.
NURS.
Yeah, I got it.
It's called Hydrate.
Yeah, just go NURS stock
Okay.
venture exchange, and it's called
There it is.
Hydrate Technologies.
And so, anyway, it's a very interesting company. You guys can meet management and stuff. They've got guys, they're in Toronto all the time. The U.S. business is run out of Vegas. And there's a guy from Vancouver, the chairman's from Vancouver. Anyway, we can introduce you, but we like this story quite a bit. Small cap thing. Then Silver Mountain is going to be our pick. You want silver names, right? We're all talking about silver. But you want, what companies do you buy? You can buy any of the larger cap equities if you want and stuff. But Silver Mountain, just to give you an idea of how stupidly cheap this thing is, they're restarting a mine in Mexico. And by our calculations, this thing's trading at 2 times EBITDA. And so they have to get the mine restarted and all that, but they've got the money. It's going to happen this year, right? Second half of 26. So they'll be up and running, and they're trading at 2 times EBITDA. We think the stock goes up multiple times. And then just to leave it on silver, I've spent the last 6 weeks every night studying the silver market and trying to get a better understanding. We think we're pretty much convinced that the whole sector is going to re-rate to about $150 an ounce, somewhere in there, and maybe higher. So is it done or not? I mean, if you look at the chart, of course, it's gone parabolic, but we've come to the conclusion that we're really the West is out of silver. We've been in deficit for 6 years now, and there just isn't enough around. So it's going to go to the physical price, which is being determined by the Chinese, and they're just going to reprice the stupid metal at something much higher. And we think the driving force is, of course, the battery technology. All those robotics, Elon Musk is everything he wants to do in the robotic space. How much silver does he need for that? And then SpaceX, how much silver does SpaceX need? All these networks, all the space industry, these new applications, they all demand silver, and so that's what's going to set the price higher, is the industrial use. And so we're thinking 150. So I don't know. I mean, we're fully invested in the space, and we still like it. And by the way, it's happened before in lead. It repriced tenfold once as an industrial play. It has happened in the past. It could happen. I mean, I don't know if it's going to happen, but we think there's a good chance it will. So anyway, Silver Mountain's a perfect pick. Or just pick any of the large developers. The large producers. You're going to get plenty of upside, and the stocks are not that expensive. So, and there are not that many of them, right? So anyway, those are our picks, and sorry to barge in like that, but and I'll flip our presentation to all you guys so you can have it all. I'll do that later this week.
When did lead get repriced?
That's a good question. The exact time, I don't know, but it was, know.
I just did a quick look, and these charts don't show that on a quick.
And a lot of guys are equally bullish on the platinum concept, that platinum will get repriced as well for all the same reasons. And
I know some platinum bulls that still think it's highly, highly undervalued. And it's the hardest element to get out of the Earth's core. You have to go the deepest into the core.
Exactly. So
So,
it's kind of like a
okay, that's exciting. So, is that the annual thing in Vancouver that
yeah,
you go to?
yeah. This guy, I'll try to get you some clients out there.
Yeah, that'd be great. And see if you can get us invited next year as a more of a different manager than you, so we wouldn't be stepping on your
Yeah,
toes.
I'll,
So put a plug in for us. We'd love to
okay.
join.
Well, I can do that. I can do
Yeah.
that for sure.
Especially my son and granddaughter and daughter-in-law are moving to Vancouver, so I'm going to have many reasons to be going to
Well, I think the
Vancouver.
simplest thing to do is I'll just tell them that you want to go. I mean, they're gonna charge you to set up a little booth, and but I think it's a good idea.
That's fine.
You'll get a bunch of clients.
I did that at the PGA show yesterday up in Orlando, and oh my God, it was like walking into a huge room with the biggest egos in the world, people in the golf industry. It was industry people only, so I got a special badge for this private company we have an investment in. And it was overwhelming. I wasn't even able to walk around to see if there was any investment firms there, which probably weren't. But no, we'd be happy to do a booth, and a couple of us would go out for
Okay, I'll
that.
set that up. I think it's a good idea.
Good stuff. Good luck. And yeah. Okay, Chris, we're going way over time today, guys. It's fine with me, but let's keep going so we can get through everybody and get Gilbert's summation.
Sure, happy to go quickly. Some economic data came out at 10 o'clock today. Nothing really, everything was in line. Core PCE year over year 2.8, same as last tick up, 1/10 higher than last month's reading, 2.7. These is November data. Interestingly enough, personal income was down 1/10, and down 1/10 over forecast. Otherwise, inflation, was calculations were spot on from last month. In the bond market, although it's getting more and more press due to Japan, in the 10-year, we're down $1, which, is roughly a little more than 1%. So, not a big deal. I saw that the withdrawals from the U.S. natural gas came out this morning at a pretty high number, but not record breaking. It was 120 billion. The forecast was 106 billion. I think the high, I looked at the chart, was 150 billion of BCF. This is a weekly statistic from the EIA. Lastly, two more things. Just like to table that I'd like to counterpoint to what Paul said in my opinion, that I think Canadian market's going to be due to a rough patch, because I think the negotiations for the USMCA, Trump's opening position, is going to be, hey folks, we don't need it, go on your own. And I don't see any evidence that people are preparing for that. And then lastly, the Canadian Gating Watch, I saw on the Globe that Cortland Credit had a private debt fund that's put up its gates. They, in a great show of diversification, they had 1/3 of the fund in one investment, a private diesel fuel refiner that went into arrears. So,
Well, that's incredible. I've been following them for years, Chris. Sorry to interrupt.
no worries.
And I think I've even talked to you about them. The
Yeah.
fellow was an ex teacher's pension plan guy. And so for him to have a third in one name,
Yeah.
in my estimation, my opinion,
If
that's
Sean knows him, do
not
you
at
know
all what they sold.
I think his
Sorry.
name is Sean Rochester, something like
That's
that.
it. Yeah.
Do you know him, Sean?
Yeah. Smart guy, very headstrong. These are all my opinions because this is a public comment here. But Ken and Joe are going to come up with a list of all the funds that are gated right now. Hopefully, they can do a deeper dive than just AI would, and that fund will be on the list for sure.
Yeah, that's it. That's it for me.
Great. Thanks, Chris. Okay, Gilbert, take it away.
Okay, thanks, David. Let me just share my screen here. I'll be quick. So this is a short report for Thursday, January 22nd. A lot of the stuff that that I'm going to discuss has already been touched at already earlier in the discussion. Again, even despite the decline that we saw coming into the start of the week based off of Trump's commentary. We're still looking at the S&P 500 well above its long-term trend line here, the 50-week exponential moving average, which has been support for quite some time. We had previously discussed this sort of wedge pattern that we saw similarly last year at the start of 2025. And obviously this decline that we saw at the start of the week had a lot to do with Trump's tariffs, which is what happened at the start of 2025 as well. And so those concerns are not unreasonable, but we're going to take a look at something a little bit later in the report, which is just going to maybe allay some concerns there. CAPE ratio continues to be pushing really, really high, but we're taking a closer look here. And again, what we see with the CAPE ratio is that there's this sort of rolling over that typically happens before we start to see the market roll over as well. And what we're seeing with the CAPE ratio is it's flattening out here at a post-dot-com peak of 40.42, which again is very, very elevated. And it's we don't want to say it's starting to roll over, but it's starting to flatten out as it did before previous declines here. Credit spreads, again, continue to be very, very tight here. And I just want to highlight this box in the bottom right here because you can see that we essentially have gotten down to this level, which is the same level we got down to in late 2024 before the decline. So what we're pointing out here are the similarities that we're seeing between the current market and the market before the start of 2025. Now, what's important to understand is that there are differences as well, which we're going to get to in a second. But first, we want to revisit defense versus growth. Ken talked about this earlier in the discussion where we're starting to see, again, rotation out of growth and into defensives. Here we're looking specifically at the consumer staple sector versus the QQQ. So we can see that this ratio peaked out around late October, early November. And since then, it's been moving higher, similar to what we saw at the start of 2022 and 2025. So again, reason to be cautious. However, one of the reasons why we don't have to be too cautious at this point is, again, as Joe pointed out earlier, participation is a little different this time around. So we can see that moving into 2025, we saw market breadth declining quite a bit before the market really rolled over. What we're seeing right now is a little bit of the opposite. We're actually seeing market participation increase despite the fact that we've had some pullback. So yes, markets are expensive, but we don't really think that we're going to see anything material until we start to see breadth deteriorate in the same way that we've seen before previous declines. And so that's essentially what we're looking at here. If, however, you're still concerned about some risks, we do have a solution here with our partners at Universa. So if this fits your profile, please reach out to us. That's it for me this time.
Okay, good long one today, everybody.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.